Welcome to Property Report UK, your trusted source for honest, data-driven insights into Britain's housing market. If you're tired of the same surface-level headlines and want the real story behind what's happening to UK property, you're in the right place. Because right now, the housing market is experiencing something unlike anything we've seen before. It's not a crash that grabs front-page headlines, and it's not the dramatic collapse of 2008. But make no mistake, this quiet shift is just as serious, and in some ways, even more dangerous. On paper, prices look stable. Mortgage rates have steadied. Estate agents are still listing homes, and buyers are still viewing them. But behind those reassuring numbers lies a very different reality, one where real property values are collapsing, household wealth is eroding, and ownership in Britain is undergoing a seismic transformation. So today, we're uncovering the truth about the UK's invisible property crash, the stealth collapse that's reshaping the entire housing system, and what it means for homeowners, landlords, tenants, and the next generation of buyers. At first glance, everything looks fine. Open a property news site and you'll see headlines about market stability, price resilience, or soft landings. Over the past 3 years, average UK house prices have risen by a modest 2.7%. Transactions are steady. Mortgage rates have stopped climbing and are even drifting slightly down. It all sounds boringly normal, but that illusion of calm is exactly the problem. Because when you adjust those figures for inflation, the truth is impossible to ignore. In real terms, UK house prices have fallen by more than 17% since 2021. That's almost identical to the collapse during the global financial crisis, except this time, no one's calling it a crash. Inflation has quietly done what a market panic could not. It's eroded the true value of property while leaving the price tags looking unchanged. Homeowners glance at their mortgage statements and think nothing's wrong, but the purchasing power of their asset, the real value of their equity, has been gutted. It's a stealth crash, hidden in plain sight. No queues outside banks, no repossession headlines, no emergency bailouts. Just a slow-motion decline, stretched out over years instead of months, designed to keep panic at bay. And that's no accident. After 2008, no government, no bank, and no homeowner could afford another visible crash. So instead, the system engineered a softer landing, a politically convenient correction that doesn't look like a collapse but feels like one for millions. The real signs of stress aren't in the headline price indices, they're in the flow of properties hitting the market. This year alone, more than 1.4 million new property listings have gone live across the UK, up nearly 4% from last year. That's a tidal wave of supply. And while agreed sales are up around 5%, completions are lagging behind. Out of 1.4 million homes listed, only 1 million went under offer and just 780,000 actually completed. That means hundreds of thousands of unsold homes sitting idle, month after month, building up inventory and quietly putting downward pressure on prices. Over 919,000 homes have had their prices reduced this year, the highest number on record. That's a 16% jump from last year. Nearly 40% of all homes that eventually sold had at least one price cut before completion. In southern England especially, the market feels saturated. More sellers than buyers. More listings than offers. Properties that do move are often the ones that drop their asking price fastest. Each cut resets the benchmark for the next listing, a slow, grinding price war that doesn't make the evening news, but feels like a recession for sellers. So why is supply flooding the market now? 3 major forces are driving homeowners to sell, and none of them are healthy. First, rising mortgage costs. More than 1.8 million homeowners are coming off ultra-cheap fixed deals this year. Many locked in at 2% back when borrowing was nearly free. Now they're facing remortgage rates closer to 5%. For the average homeowner, that's a 30–50% jump in monthly payments overnight. Some can tighten belts and manage it. Many can't. And when the math no longer works, there's only one option: sell, often quickly, often for less than planned. These aren't discretionary sellers chasing lifestyle moves. These are forced sellers trying to escape rising costs before they drown in debt. Second, pensioners and older homeowners. Since 2024, downsizing among older Britons has surged by over 25%. On the surface, that sounds natural: retirees looking for smaller, manageable homes. But dig deeper, and fear is the motivator: fear of inheritance tax, fear of capital gains reforms, fear that future governments will target property wealth. With constant talk of taxing assets and redistributing housing wealth, many are selling early, gifting homes to children, or cashing out entirely. It's defensive behavior, and it's pouring more supply into the market. Third, landlords. This is the biggest shock of all. Nearly 1 in 3 UK landlords has already sold or is in the process of selling their rental properties. The reason? The Renters' Rights Act 2025, a landmark law that completely changes the landlord-tenant relationship. No more no-fault evictions under Section 21. Tenancies are now rolling contracts. Evictions require formal grounds, 4 months' notice, and strict compliance. Landlords must register publicly, join an ombudsman, allow pets, and meet tougher EPC standards. Fines for non-compliance range from £7,000 to £40,000. In short, being a small private landlord has gone from profitable to punishing. And they're leaving the sector in droves. Ironically, those exits are now the single biggest cause of tenant homelessness in the UK. The very legislation meant to protect renters is pushing them out of their homes as landlords sell up beneath them. But here's the twist: as individual landlords retreat, someone else is stepping in, and they're not small-time investors. They're corporations. In 2024 alone, institutional investors poured £5 billion into UK build-to-rent projects, a record-breaking figure. There are now 132,000 completed corporate-owned rental homes across Britain, with another 50,000 under construction. Since 2016, total investment in build-to-rent has surpassed £34 billion. Pension funds, private equity firms, and global institutions like Lloyds, Legal & General, and Grainger are building massive rental portfolios. Grainger owns over 11,000 homes and is developing nearly 9,000 more. Lloyds Banking Group plans to own 50,000 rental homes by 2030 through its Citra Living brand. Legal & General has invested more than £3 billion in rental housing. A decade ago, build-to-rent made up less than 1% of new housing. Today it's 10%. Within the next decade, analysts predict it could account for a third of the private rental market. More than 1.7 million homes owned not by individuals, but by corporations. These companies aren't buying single flats or small homes. They're purchasing entire developments, managing thousands of units at scale, and locking in steady, inflation-linked rental income. And unlike small landlords, they're not afraid of regulation, they welcome it. They have compliance teams, lawyers, lobbyists. The same red tape that's driving individuals out is barely a speed bump for them. This marks a historic transition in who owns British housing. For decades, property ownership was fragmented: millions of individuals, each with their own stake. Now, ownership is concentrating into the hands of a few institutional giants. Once corporations control enough of the rental market, they'll hold pricing power. They'll set rents across regions, control availability, and influence government policy through lobbying. What we're seeing isn't just an economic change, it's a structural shift in power. Housing, the foundation of British family wealth, is becoming a corporate asset class. There's another uncomfortable truth. For homes to become affordable again, experts say prices need to stagnate for about 30 years, allowing wages to catch up. That would be great news for first-time buyers, but catastrophic for existing homeowners whose wealth depends on rising values. A generation's retirement plans would evaporate. Their financial security would disappear. Politically, that's impossible to sell. Economically, it's painful. And socially, it sets up a generational conflict: younger Britons desperate for lower prices versus older owners clinging to property wealth. Meanwhile, rents are soaring. The average rent in England is now £1,348 per month, up nearly 9% in a single year and 40% over the past 5 years. Wage growth hasn't kept pace. Renters are spending more, saving less, and competing harder with each available property receiving 10 or more applications. The result: fewer renters become buyers, landlords keep selling, and corporations keep buying everything they leave behind. And the picture isn't uniform. The UK property market has split into two realities. In the North and Scotland, prices are rising. Some areas, like the North East, have seen double-digit annual growth up to 14%. Homes there are selling faster than anywhere else. But in the South, especially London and the coastal counties, prices are slipping. In places like Worthing and Torbay, values are down nearly 4%, and high-end homes above £500,000 are barely moving. The average time to sell in London is now 45 days, up 20% from last year. Wealthy buyers are waiting to see what the next budget brings, wary of new taxes or policy shifts. The UK is no longer one market. It's dozens of fragmented micro-markets, some booming, some stagnating, and some already quietly crashing. What's happening right now isn't temporary. It's a restructuring of Britain's housing system. Home ownership is shrinking. Private landlords are disappearing. Corporate investors are expanding faster than ever. Real prices are falling even as nominal prices appear stable. Rents are surging while supply tightens. And yet, the government is relying on these same corporations to build the homes individuals no longer can. It's a paradox, a system that's solving one problem by creating another. If the trend continues, housing in the UK could shift from being a personal asset to being a permanent rental commodity owned, priced, and controlled by a handful of massive financial players. Once that happens, reversing it will be nearly impossible. So here's the question: is this the inevitable evolution of the housing market, or a political choice that could still be changed? Because the next 5 years will decide the next 50. The laws, taxes, and investments being shaped right now will determine who owns Britain's homes in the future: ordinary families or powerful institutions. If this report helped you see what's really happening beneath the surface, don't let it stop here. Share this video with someone who still believes the market is fine. Subscribe to Property Report UK for clear, independent coverage of the housing trends that truly matter. We cut through the noise to bring you the real data, the real risks, and the real future of UK property. Stay informed, stay ahead, and we'll see you in the next one right here on Property Report UK.